Balance sheet. It's not as sexy as the income statement. You aren't going to be able to see the demand for their products or the margin that they're commanding, but the balance sheet will tell you the health of the company. It'll let you pull back the curtain and look past their earnings to understand their health and if they can survive a market downturn. From the most basic level, assets equal liabilities plus stockholders' equity. Assets are what a company owns or controls that will generate future value. Liabilities is what a company owes, and stockholders' equity is what's left over for the owners, so us as investors, if they were to use all of their assets to pay off all of their liabilities. The balance sheet is important because it tests structural survivability. A company could look at incredibly profitable on their income statement, but they could be on the verge of bankruptcy if it ran out of cash or if they face a mountain of debt. It also can reveal capital efficiency. It tells you how much and where they're spending their money. And it answers the ultimate question of financial safety, which is if the economy crashes tomorrow, how long can a business survive without needing a bailout, needing to take any loan that they can get their hands on, or needing to issue additional shares that would dilute current shareholders? Before diving into each individual line item, please just go down below, take 5 seconds, hit that like button and that subscribe button. I greatly appreciate it. And without further ado, let's dive into understanding each line item so you're an expert at reading a balance sheet by the end of this video. So starting off with assets. So they're separated into two buckets, current assets and then non-current assets. Current assets are things that can convert to cash in less than 1 year, so think of like immediate liquidity, and non-current would be anything that would take longer to convert to cash. So the first line item, cash and cash equivalents. It's exactly how it sounds. This is pure money in the bank that they have or ultra safe like short-term investments such as like US Treasury bills that can quickly be converted to cash in a quick manner. And this line item is very important because it shows that a business's immediate cushion that they have, and this line item helps them pay for daily operations. If they have any like sudden legal settlements, they can use these. Next up, marketable securities. So these are highly liquid investments. Think of short-term bonds that lets the company collect a bit of interest on rather than sitting in cash in a bank account earning a much smaller amount of interest. But these are items that could be sold in a very quick time, usually in the matter of days for cash. And oftentimes investors group cash and cash equivalents and marketable securities together. By grouping these two together, this really shows the business what sort of war chest do they have to fund different investment opportunities or different build outs. So for example, in Meta's case, helping them to build out the massive AI infrastructure that they're building. Next up, accounts receivable. So this is money that is owed from customers to the company. So in Meta's case, these are advertisers that owe money to Meta for ads that have already ran on their various platforms. And then this little net call out here, they take a small percent that they expect to default. So essentially the customers they expect not to pay, and they factor that into this number. This line item can be important because if you start seeing accounts receivable spike faster than revenue, it could indicate that a company is having a hard time collecting payment from their customers. But in Meta's case, we can see that quarter over quarter, this number is actually down while we know revenue is increasing. So, from a health standpoint, this is a good sign for Meta. Next line, prepaid expenses and other current assets. These are things that Meta has already paid ahead of time. So in Meta's case, this could be different software licenses or upfront supplier agreements that they plan to consume within the next 12 months. Now, hopping down to the next area, all of these line items will be non-current assets. So these are more longer term assets that could be hard to convert in a short time horizon. First item, non-marketable equity investments. These are ownership that Meta has in other companies that are not public. So it's under the non-current item because since it's not a public company, it could be very difficult to sell these investments in order to get cash in a quick time manner. Property and equipment, on some balance sheets, it might be called property, plant, and equipment. Essentially, this represents a company's physical footprint. So for Meta, think of all the data centers they have, the physical land that those buildings sit on, the different corporate buildings they have, and also all those AI chips that they're buying from NVIDIA, AMD, and other chip providers. That would fall under here as well. And then the net part of this is just indicating that it's net of depreciation. Operating lease right of use assets is just in accordance to when they sign long-term lease agreements for office buildings or data centers, they must account for this on this line item. Goodwill, for this line item for Meta, this could be specific to when they're buying another company and they pay more than what the literal net worth is of these physical assets. That premium then is logged here as goodwill. And then other assets, this would be really any miscellaneous asset that didn't fit into any of the buckets above. So that is the assets. So remember, assets are anything that the company owns or controls that's going to help generate future economic value for them. Now let's dive into liability. So this is what the company owes. And same as with assets, this is broken up by current liabilities, so things that will be owed in less than 12 months. And then after that will be non-current liabilities, which will be anything that's longer than 12 months. Starting off with accounts payable. These are short-term bills that Meta owes to its suppliers for goods and services that have already been delivered. So think of them building out various data centers, the bills that they owe to construction companies, or also all the utilities that are powering these buildings. That would fall under here as well. Operating lease liabilities, current. This is anything from a lease standpoint that's going to be owed in less than 12 months. If we hop down to the non-current, there's the exact same line item. This is the amount that's already contractually agreed upon, but won't be owed in less than 12 months. It's everything that's greater than 12 months out. Accrued expenses and other current liabilities. So these are going to be obligations that Meta has incurred, but they likely haven't received an invoice on already. So this could include employee bonuses, unpaid payroll taxes, or they might set aside some short-term reserves that might be used for different legal matters. Down to long-term debt. This will be the amount that a company has taken out via loan, or maybe they offer different corporate bonds that they have to pay back. So in Meta's case, this is tracking the total value of corporate bonds that they've issued. Now, seeing a company have debt on their balance sheet doesn't automatically mean it's a bad thing. Companies will oftentimes leverage debt to accelerate their growth, especially in times when interest rates are low. So if we think back to the COVID years in 2020 and 2021 when interest rates were near zero, this was a great time for great companies to leverage very cheap debt to accelerate their growth. But from a very high level, we don't want to see debt on the balance sheet be higher than the cash and marketable securities line. For a healthy balance sheet, we would have higher cash plus marketable securities versus total debt. This ensures that a company is not over leveraging themselves in a worst case scenario where they need to go pay off all their debt. Looking at long-term income taxes. These are taxes that are owed to the government that are due in more than 12 months into the future. So these typically could consist of long-term tax liabilities payable and deferred tax liabilities. Other liabilities, these will be miscellaneous liabilities that just didn't fit well in any of the above categories. Hopping down to stockholders' equity. So this will be a category that focuses on the remaining value of assets after you remove all the liabilities. So starting at common stock and additional paid in capital, this will help to represent the real amount of money that investors have poured into Meta over time. Accumulated other comprehensive income or loss. This is just a technical line item for holding unrealized gains or losses that just don't pass through the regular income statement. Retained earnings, this is the accumulative amount of profit that a company has earned since day one. And ultimately, total stockholders' equity equals total assets minus total liabilities. So that is a little bit about every single line item on the balance sheet. I hope by now you are an expert at reading a balance sheet and you can go out and start practicing and reviewing a balance sheet efficiently now. Remember, from a high level, at the very basic level, look at what a company's cash and cash equivalents plus marketable securities are, and then compare that to their total debt level. And we want to look at companies that have more cash and marketable securities than they do debt. So if this video was helpful in helping you understand what a balance sheet is and why it's important, then all I ask from you is hit that like button, hit that subscribe button, and stay tuned. In the future, I will do a review of a couple companies' balance sheets to determine if they have a healthy balance sheet or if they have an unhealthy balance sheet in order to help you understand what I look for to determine if the company is in a good place or not. Until then, let's focus on the long term. Continue to research your companies to understand the long term fundamentals of the business. Until then, take it easy. I'll see you in the next one.